Good morning, ladies and gentlemen. This is Butch Shorak, Options University, Monday, May 14th, 2012. Access to this webinar is for educational and informational purposes only. Nothing contained in this video, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Options University provides educational services that are meant to teach you the risks and rewards of trading stocks and options, and we are not a service that tells you what to trade. We are not implying or guaranteeing profit. You must take ownership for your own trades and for your own money. It's part of being an informed investor. With that, let's take a look at the week that was. As we see during the last week, there's very little that took place on Monday, Tuesday, or Wednesday. And then as we come into Thursday, of course, we came up with the jobless claims, which came out at 8:30 on Thursday morning before the market opened, actually were slightly below the 370,000, which is they're slightly below 370,000, which is generally a little bit greater than what was expected at about 365. But certainly no big strain on the market, as it was right in back pretty close to in line, and as such, there wasn't much change to the market. On Friday, what we had is we had the PPI come out, and we had consumer sentiment come out as some of the data that came out through the weekend, and this did have an effect on the market. So as we saw, there was a surprise improvement in the consumer sentiment survey, which comes from the University of Michigan, and it seemed to encourage traders to extend the bounce that took place in the morning. The consumer sentiment came out at 5 minutes to 10, and as such, we saw the market pull back at the very beginning of the morning, and then almost shortly after it opened, it started to pull back with tech leading the way up. With the consumer sentiment, the survey reading of 77.8 marked an improvement over the 76.4 that had been posted in the prior month, and it beat the expectations of 76. So 77.8 on the consumer sentiment survey from Michigan helped boosted the market. The PPI, which came out earlier at 8:30, was a surprise with a 0.2% decline in overall producer prices during April. The 0.2 increase in core producer prices, which means that they took out gas and food, was exactly what had been expected. So PPI did not provide for us much impetus in the market on Friday, and so Friday was an interesting day in the market, as we'll look at the SPX chart in just a couple of minutes. Let's take a look at what's coming for the next week. Monday looks rather blasé, nothing much there. CPI, which takes place before the market opens on Tuesday, absolutely can move the market. And then with some retail sales and the Empire State Manufacturing Survey, we definitely have news coming out Tuesday before the market opens. Monday, kind of a slouch day. Remember, this is options expiration week. Friday is options expiration week, and you know that I always can provide some volatility to the market, and a little more uncertainty as to what's going on. We got some housing starts coming out on Wednesday, which probably won't have much effect on the market. And then, of course, every Thursday we have the jobless claims for the previous week. How many new people started collecting unemployment or filed for unemployment. We have that coming out on Thursday before the market opens. And then two very important indicators that certainly have data that can move the market. We see that when we have the Philly Fed survey on Thursday, and we have economic leading indicators on Thursday. So we've got some more announcements this week than we had last week, as last week the market pretty well drifted at the beginning of the week with very few economic data to have the market move. And you see that we still pretty much have closed up in this yellow zone where we seem to be going in a sideways movement after having the many months of that stair-step climb, which we've talked about many times. So far the trend is down. We've tried to go to new lows. We did enter into this, but notice that when it came to the close at the end of the day, we were still above or in that yellow zone. So the long tails on those. Notice the size of, in fact, let's go to the next chart. We'll see that even a little better. Notice the size of the candlesticks. Candlesticks got much bigger during our downtrend. But notice as we got down here, the size of the candlesticks and the tails on those candlesticks, as there was an attempt to bulls to keep it up in that same sideways trading range that we've been in for about a month and a half. And we very well could continue until the end of May in this trading zone. Again, we're at this crucial point. I've talked about it all last week, in that we can start heading up here and bounce off of this level. This is support. It is a triple bottom. We've got a single bottom right over there. We've got a double bottom right here, and this is our triple bottom. So we could get breakdown and go down this way. So until we get some real confirmation, we don't know which way the market's going. Add to that the confusion and the schizophrenia of having the options expiration next week. This week that we're in should certainly be an interesting week in the market, and probably a bit difficult to trade because of the lack of trend. So you better take advantage of theta if you're going to be trading in this kind of week. If we look at the overall market last week, we see that the indexes in general were down percentage-wise, detracting from the year-to-date growth. As we see, the Dow was down 1.7%, big chunk for the Dow. Still for the year up 4.9%, so whittling away at that great first quarter that we had, which we knew was unrealistic to expect the market to keep moving at that same pace. NASDAQ down 22 points for the week, and down 0.8% for the week. Still up year to date 12.6, but this has been a bit of a laggard, as it had its big move in the first quarter, and in April didn't really do all that much. S&P, which we use as one of our main guidelines to see what the overall market's doing, because of the strength of having the 500 of the world's greatest companies listed in it, was down 15 for the week, which is a percentage of 1.1%, just barely over 1%, still up 7.6% for the year, as the S&P has tallied very well at the first quarter, but not showing that kind of strength this week. Russell, really the market leader, down only 0.2%, has not shown any big movements one way or the other. As we see for the year, it's up 6.6%. Russell has been kind of lagging the overall markets, not showing much leadership as we've gone into April and May. Watch for the Russell. It certainly could provide leadership as if when we head down, in the end of May, as we have that old saying, go away in May. Well, we're approaching that time where there is added risk in the market as we approach the end of May. The main season for the big-time traders tends to pull off a little bit. As we looked at earnings season, beginning to come to a draw, we did have some great news out of Disney, which is one of the Dow stocks, and it reached a 52-week high on its earnings, revenues, and forecasts. Cisco dipped on disappointing forecast, even though it had great earnings and great revenues for the previous quarter. Macy's had upside earnings and showed good strength in its stocks. So there's still a bit of earnings dribbling in, but the main part of earnings season is now behind us, and it'll be economic news, and certainly some effect from Europe as we see these things affecting the market. Lots of talk last week about Greece and its effect on the market, as their new solidarity government, some doubts as to which direction they're going to be led by their new leaders. It seems to me that they have to have something to talk about. I don't know how important Greece is to the overall picture, but it's certainly been in the news and does seem to have an effect on the market. As we look at the Dow, we see that we did not reach that previous low. There's a low, there's a low, and here we are with the low this week, and waiting for confirmation to the upside with higher highs and higher lows. It has been in a down cycle for 1, 2, 3, 4, 5, 6, 7, 8, 9 days. So time for the Dow to pick it up. One of these is going to lead us up into a bounce, most likely into this yellow zone here. The Dow could be what could lead us. We also could look for the NASDAQ to lead us as we go into this options expiration week. NASDAQ showed less relative strength than the other markets as we went out of its sideways trading zone and went back to find this low, which we had back in March. And so we got out of that trading zone and dropped down into a weaker trading zone for the NASDAQ. But again, we're looking for that higher high. We did get a higher high, but we got a lower low on Friday, which negated it. So we had an outside day with our candlesticks. The market was led up early by the NASDAQ, but as we looked at Friday, Friday sold off going into the weekend and basically closed closer to the bottom of the day's range than it did to the top of the day's range. And so NASDAQ did not hold on to its gains in spite of the fact that it let it above Thursday's high. So NASDAQ could provide some leadership if we're going to be headed up. Keep your eye on the NASDAQ as to what it can do for both itself and the other indexes. Russell is just traded sideways for the entire week. Didn't show us any strength, didn't show us any leadership. Trading within its zone that it's been trading in for quite some time, and not a lot of noise coming out of the Russell 2000. As we look at the VIX, we see that during the week, this week, we finally had enough volatility to pull it out of its normal trading range, that is between 14 and around 20. It actually pulled up, basically had about a 10% increase at one point. That took place on Tuesday, and then we see that it went up higher even on Wednesday, and then finally we pulled back into our more normal range on Thursday and Friday, as we see the market having a bit of higher volatility as the market has pulled back during the last basically 2 weeks. So the VIX back in its normal trading range where it spends about 85% of its time. All right, with the bond market, of course, responded to the market pulling back, and on Friday went to a higher high outside of its normal trading range that it had been spending a great deal of time at. We had the pullback in the bond market there as the market went up, and as we saw the market tending to go sideways and pulling back, we've seen some money flowing out of the market into bonds as the increase in demand for the bond market it can be experienced and looked at by looking at this ETF called the TLT. One of the ways for you to participate in bonds without buying individual bonds, trades like a stock, great ETF to keep your eye on, TLT. Look for your buy and sell signals. Is generally a contrarian indicator to the overall equity market. Financials, look at that, dropped out of that zone on Friday. Big news came out on the weekend about JP Morgan. There's some concern about the health and transparency of operations at these what we call diversified banks and financial institutions. JP Morgan Chase is considered among the best in the business, and it announced that it had a $2 billion trading loss. Of course, it didn't make much difference to market participants. That part of the loss was partially offset by $1 billion in security gains, but it doesn't make any difference. That's big news when traders or a group of traders drops a couple $1 billion for these banks. Stock suffered its worst percentage drop since late last summer and drew down the rest of the financial sector, which surrendered about 1.2% for the day. As we see, it was down 17 cents for the exchange-traded fund called XLF, which brings in all of the, well, not all, but a multitude of the different financial instruments in order to give us that ETF, which of course gives us a diversified fund. Next, we're going to take a look at oil and see what oil did during the week as it closed very near the low of the week, consolidating with the overall market after this pullback, which took place right in here. And we saw that crude oil fell about 2.5% for the week to a 2012 closing low of 96.03. So under $100 a barrel goes oil, and we'll see if that'll be reflected where we really want it reflected, and that's at the gas tank. So we'll see what happens with oil. When you look at USO and ETF, which also can give you buy signals, sell signals, and all the other things that you're looking for when you're looking at a chart. So keep an eye on these. We're in a new trading range for oil. And if it's going to bounce, what we look for is higher highs and higher lows. And currently, we see that we are spending time below the 50, 30, and 10-day moving average. So consider yourselves in a downtrend on oil, as we've seen that since February, it's basically been headed down. I've not seen a lot of effect at the gas pump, so let's see if that begins to happen here as time goes on. Let's take a look at gold. Gold for the week went outside of its trading range, trading down below that level, and gold prices fell to $1,584 an ounce for a 3.7% weekly loss. Closing at the low of the week for this commodity, we see that on Friday. There it is at the very bottom of its range for the week. And we look at GLD, which again is one of those ETFs that can allow us to track this easily, and certainly is a tradable commodity as we broke out of its trading zone that it had been in for about 2 months. So gold is another way for you to use a diversified fund to extract money from the market, which is basically what we're interested in doing. Looking at the SPY with volume, we saw we had big volume days on these downtrending days, and the biggest volume took place on this, what ended up being an exhaustion day. We see that we popped up on Thursday. Friday lost that momentum going into the close, closed in the bottom third of the day. We did end up with a high of the day that approached Thursday's high. So Spider's showing us that we have really no gaps to fill here. We are in a down cycle, having trouble breaking up to the upside. We'll see if we eventually do that. Look for higher highs and higher lows on the Spider to begin your bullish attack of the market if that's the case. This is a line of demarcation here for us, and we will be able to tell that at the close of the day. All right. So for those of you that are gold members, we're going to go look at our other charts of our momentum stocks that we like to look at weekly. Actually look at them twice a week for our gold members. For those of you that are not gold members, we had an interesting week in the market. This coming week certainly could provide interest as we head into the options expiration week. And for those that are gold members, we will continue with our list of stocks to watch. For others, if you're interested in more free videos from Options University, go to www.optionsuniversity.com/freegold, and you will see a printout of that at the end of this video. So for those of you that have been leaving us, thank you. Our gold members, hold on, and we'll look at the week to come for our momentum stocks. This is Butcher Options University, Monday, April 14th, 2012. Thank you for being here.